Hello and welcome to Budget Makers. My guest on the show today is Bharat Iyer of JPMorgan. Bharat, good to have you on ET Now. Thank you for joining us.
Thanks for having me on Market Makers.
First, characterize the market environment for us. When we started the year, Indian markets were at the top of the heap. But now, we clearly have emerged as the big laggard for the years. And we are at the bottom of the heap.
Well, I guess, Nikunj, we have to realize that last year was very good for Indian equities. The market went up almost 25 to 30%, backed by both global liquidity and a spate of reforms announced. I guess to put things in context, now we are a very over-owned market in the context of emerging markets. Investors have put in a lot of money. And I guess it's going to take some time for the reform momentum to translate into growth momentum. And over the interim, we'll have to live with the face of consolidation. And I guess that's where the markets are at this point in time.
Net, do you think budget has done precious little to nudge the market needle? There's nothing which could change or which could improve the EPS for next year?
Well, I think you're right there. I mean, in terms of the earnings outlook, I don't think the budget's changed much. But Nikunj, we must remember that, the budget is for the people of India at large and for the economy. And, it can't necessarily focus over the short term on either the corporate sector or the equity markets. So I guess, the government has a different agenda. And the markets perhaps went in with very high expectations, expecting the markets to be the focus of the budget. And that did not happen.
But has the budget made a serious case for Reserve Bank of India to cut rates? Have they laid a very strong foundation with getting some fiscal discipline back?
I would think so. I think, the central bank has been saying for some time now that, growth is going meaningfully below the potential trend level. And I think we're getting some joy on the inflation side also. So all this does imply that, there is scope for cutting.
If Reserve Bank of India does a 25 or 19th of March, will that surprise you? Will that surprise markets?
I don't think so. I think a 25 basis point rate cut on March 19th is very much priced in at this point in time. It's very much part of the expectation subset of investors. Yes, anything more than that perhaps would surprise markets positively.
Post-budget, the bond yields have reversed. The bond yields have gone up and rupee has come down.
Yeah.
Are macros looking bad now?
I don't think, the budget doesn't change the macros in just one stroke of a pen. So I guess, the macros has been stretched for some time. And I guess it's not going to change in a hurry. And that's something the financial markets will have to contend with.
But are macros looking bad?
I think the macros are looking stretched. There's no denying the fact that, both the deficits are very, very stretched. We don't need them at these levels. Growth is seriously challenged. I think the street is underestimating the extent of the growth slowdown. So it's not a very good combination to have at this point.
Many experts are also of the view that the GDP number which came out for the quarter gone by of sub 5%, that will mark as an absolute bottom for Indian economy.
It could mark a bottom. I wouldn't dispute that. But I guess the issue is we're probably in for a U-shaped recovery rather than a V-shaped recovery. So, I'm not one of those who thinks that, we're going back to 6.5 or 7% in a hurry. Probably, we hang around 4.5 to 5% for another quarter or two, and then gradually make our way up to somewhere between 5 and 6%. But so it seems to say, our opinion is that, we're probably in for a U-shaped recovery rather than for a V-shaped recovery.
At a time when earnings are contracting, do you expect that this year Indian markets are unlikely to generate positive return because your Sensex target is sub 18,000?
Yeah, I think, our sense is that near term the market perhaps on the Sensex, goes down to somewhere between 17 and 18,000. And that's really premised on the fact that current earnings expectations seem very high to us. The street estimates right now are for about 16% earnings growth. For an economy growing at about 5 to 6%, we think that's a little far-fetched. I think we'd be more comfortable with earnings growth in the region of about 10%, and we think the markets need to adjust to that.
So you are not of the view that earning expectations or EPS estimates for FY14, they need to be upgraded. You are of the view that they will get downgraded before you would like to revise them.
I think they will get downgraded because, as I said, 16% is a number which is fairly challenging in the backdrop of the macro that we have right now. For starters, the budget has imposed a surcharge on corporate profits. That itself will shave off about 1.5% in earnings growth. And then I guess, the earnings growth numbers, I think, are more geared towards a GDP growth in the region of 6.5 to 7%. Whereas, I think perhaps we'll perhaps end up at 5.5, 6% for next year. So I do think there is downside out there.
So do you think Indian markets currently are stuck between rock and hard surface? One side you've got the consumption cycle, which is slowing down. On the other side, you've got the investment cycle, which is yet to pick up.
Well, I guess, you're partially right in the sense that, it is a difficult environment. It's a challenging environment. To be fair to the government, a lot of initiatives have been seeded. But these initiatives are going to take some time to fructify. And perhaps second half of the year is when, we really start seeing the benefits of these initiatives. But over the interim, the market will have to contend with weak economic data. And that's something it's not going to like, particularly in the backdrop of the expectations that are there right now.
Closer to 18,000 on the index, you would be a buyer?
I don't know, because, markets can get cheap and remain cheap for a long time. So I guess, it depends on how the macro responds to the initiatives that the government has put through. But yeah, we are hopeful that, a number of initiatives have been taken, they've been seeded. And if they start bearing fruit, then who knows? Yes, I mean, it would be time to get positive. But yeah, I think the first leg we're calling for is down rather than up.
But at a time when so much of global liquidity is sloshing around, is there a case for PE expansion? Because more than earnings expansion for FY12, we actually saw a big PE expansion.
I think that's a story, Nikunj, that's already played out. I mean, if you look at the last 6 months, or if you look at the time frame between September and December, the markets went up purely on PE re-rating. And what helped was that the government did the right things, but we were also helped by very substantial flows and a very conducive liquidity environment. That said, yes, if money keeps coming in, I guess markets will sustain their performance. But that said, I guess the relative case also gets a little weak, because India is now, as I mentioned to you earlier, a seriously over-owned market. I mean, in the context of emerging markets vis-a-vis the benchmark, I think this is the highest overweight position I've seen in nearly 6 or 7 years. So that incremental attraction is a more challenging aspect right now, rather than what it was 5 or 6 months back when we were under-owned.
But for next 6 months, do you think Indian markets will focus more on the micros or the macros?
I guess it will continue to focus on the macro, because let's face it, we are going into a lean season as far as the economy is concerned. And secondly, I guess no one expects growth to make a very serious comeback. Yes, bottoming out is fine, but are we going in for a V-shaped recovery? I think I don't think even the optimists are calling for a very acute curve out there. So I guess the focus will continue to be on the macro.
So it's going to be a grind up. It's not going to be a V-shaped rally.
No, I wouldn't say it's going to be a V-shaped rally. I think a good outcome will be if we can consolidate around the current levels, give or take 1,000 points on the Sensex on either side. And then into the second half start making a move up.
At the current juncture, where to your mind markets are exactly mispricing growth? A on the upside, then B on the downside?
I think markets are mispricing growth on the, the markets seem to be a little more optimistic on growth than I think they should be.
In terms of some key sectors?
If you look at sectoral earnings growth numbers, I guess the 2 or 3 areas that stand out where, I think there is mispricing, I would say financials for one. I would say the consumption basket for one, including telecom. And if I could expand there, if you look at consumption basket right now, I think, consumption is definitely slowing, because after a long time, you have wage inflation beginning to lag the overall inflation. And, in an economy which is growing at 5 to 6%, job creation is not, or employment generation is not exactly great. So I guess, this is now finally getting reflected in consumption. But if you look at earnings growth numbers, I think the street is still going for earnings growth in the range of 20 to 25%, depending on whose numbers you look at. I think that's going to be a challenge at this point in time. I think those numbers need to be revised down, both particularly on the discretionary side, but to a certain extent on the staple side as well. Again, if you look at financials, the street is estimating earnings growth well in excess of 20% at this point in time, and it's quite a challenging environment. You have credit growth at just about 15-16%. Secondly, I think there is a case for margin compression there as well, because deposit growth is trailing even behind at about 12%, 13%. And monetary transmission is proving to be a challenge for the policymakers. So in that environment, again, I think with credit growth being constrained and with margins expected to get compressed, I think those numbers need downward revision. So those are the 2 areas where I see substantial scope for downward revision.
But tactically, are you bullish on private banks or are you bullish on PSU banks?
We have been bullish on private banks for a long time now. I mean, perhaps 15, 18 months now. And we see no reason to change our call on that, because the private banks, at least particularly in this kind of environment, the more high quality private sector banks are perhaps much more insulated, and they have a deposit franchise which is very good. Their loan books have much better quality, and so the potential for write downs is that much limited. And again, they can pick and choose their customers in an environment like this.
The fact that Indian markets are underperforming other developed markets and regional markets, do you think in the near term we run the risk of outflows? Because if global liquidity is sloshing around, global liquidity eventually would like to chase winners and performers. No one wants to associate with a laggard, or no one wants to associate with underperforming market.
I hope not, because I think
that would be disaster otherwise.
I think, outflows would be a very challenging situation, because I guess, it's not just the vulnerability of the markets itself to the outflows. It's the vulnerability of the entire economy because of the high current account deficit that we run. And, the fact that we bridge that current account largely through capital flows, particularly portfolio flows. So I hope not. Again, I don't think, there is a case for huge outflows, because first and foremost, as you rightly mentioned, central banks all over the world are running very easy monetary policy, and we don't see that changing in a hurry. So liquidity is going to remain benign. That's a core underlying assumption that we're making. Secondly, to be fair to the government, it's done a fair bit in the last 6-7 months. And so there's no reason for, investors to really vote with their feet in terms of running away from the market. I mean, there's nothing structurally wrong. If anything, things have got better in the last 6 months than they've been for a while. So I don't see, I don't see the need for substantial outflows. But yes, what I'm worried about is if even if the momentum of flows starts slackening, it can have an impact on the currency, because let's face it, our economy is getting bigger, the current account is getting bigger. So we need more flows to bridge the gap.
And we'll have to borrow that otherwise.
We'll have to, find ways of getting it, either through portfolio flows or through ECBs or through, bonds, or, let the currency slip.
So where will the ultimate trigger for Indian markets come from? Will it be earnings? Will it be liquidity? Or it has to do with macros or government reforms?
See, so far it's basically been running on liquidity and on government reforms. And I guess, we've had a reasonable run on the back of that. I guess in terms of the next level, the next trigger, I guess, it'll obviously be led by the macro, because in an economy like India, which has a fair degree of regulation, you would expect the macro to play a very important role. But yes, at some point in time, investors are also going to want the earnings cycle to start picking up, because we've been in this downgrade cycle for what, nearly 24-30 months, or thereabouts. So I guess patience starts wearing off after a point in time. So I think investors are keenly waiting for the earnings cycle to start reviving.
Do you think currently there is deep value in industrials, because the investment cycle eventually will pick up? And if I look at the large cap industrial names, stroke the machinery names, BHEL, L&T, Crompton Greaves, things are looking smashed there.
Well, there is deep value in across the investment cycle. It's not just the capital goods manufacturers. I mean, even if you look at the infrastructure names, I think there is deep value across the investment space. The only issue I have with the space is it's cheap, and it could probably remain cheap for a while, because it's difficult to see the investment cycle picking up in a tearing hurry. If you look at the private sector, gearing levels are at 15-year highs. Monetary transmission is going to take some time to work its way through the system. And I guess there are limited stimuli available. So I guess, it's a very exciting space if you have a 3-year time frame in mind, or, even a 2-year time frame in mind. But on a 6-month basis, still looks challenged.
If I map the performance for this year for the Nifty, it's clearly IT all the way. Infosys, TCS, HCL Technologies. Now, the big tailwind for IT is currency, and globally it is hopes that American economy will recover. But in the near term, do you think IT will continue to outperform because we are in a messy environment?
I think IT will continue to outperform. We've been, buyers of IT stocks since December. We've been overweight the sector. And 2 or 3 reasons really. One is, as you rightly mentioned, the outlook for IT spending is definitely picking up. And we expect one more leg up into the second half of this year. Valuations have not been very demanding. The currency is definitely a tailwind, though I wouldn't ascribe a very high multiple to the excess earnings you get out of currency depreciation. And it's been a very under-owned sector. So in that sense, even as investors rebalance their portfolios in favor of this sector, that's going to lead to some froth. But that's the nature of the game.
What are thoughts on autos? Because Street is pretty much divided on how to approach autos. The bulls would argue rates will come back, demand will also make a comeback. The bears would argue that auto stocks are expensive, wage inflation has gone up, and the competition only will intensify going forward.
See, we are underweight on the auto sector at this point in time. If anything, I think we went negative on the sector a little too early. But, we're thankful that, finally the call's beginning to play out. As far as autos is concerned, I guess, the key headwind for the sector is that cost of ownership is going up very meaningfully, because, inflation's remained high for a period now. Interest rates are on the margin coming off, but they're nowhere near the lows we saw a few years back when demand was very healthy. Fuel prices have gone up very, very significantly. So, in the backdrop of weak economic growth, high inflation, a serious increase in cost of ownership, I think, typically never augurs well for sector growth. And, the sector has actually held out very well. I mean, bar January, if you look at last year, the second half, even the volumes had started coming off, the sector held out very well. So, and, I guess that was a little to do with lack of choice, because let's face it, at the end of the day, these are companies with very relatively clean balance sheets. So I guess that's why, a lot of investors got into that space. But that said, they can't go on contending with low growth for an extended period of time, which is the reason we think that, the sector probably needs to correct.
What about global cyclicals? Names like Sterlite, Hindalco, Tata Steel, they've been beaten black and blue. And historically, I've always seen that every time for those who bought cyclical stocks, when they've gone below the book, the returns have been quite rewarding.
See, again, I think, just like industrials, if anything more so, the global cyclicals, I think, is a very interesting space. Particularly, the metal sector that you mentioned. And, we think there's a lot of deep value out there. The issue, again, is, what happens short term. Because, I think, you would have noticed that even over the last 2 to 3 months, globally metal sector stocks did rally. But in India,
come down also.
Yeah, they've come down also, but they did rally. Whereas in India, the Indian metal names just did not participate in that performance. And the reason for that has got largely to do with the local regulatory environment. Because most of these companies are stuck somewhere in terms of taking their projects forward, particularly in terms of environmental clearances and so on and so forth, which again, I think is right now a headwind. And I guess, until you see let's face it, it's not that the global environment is all rosy and, everything is hunky-dory. So I think, this is a very challenging environment. Again, I'll reiterate what I said for the investment cycle in the case of this space too. You have a 2 to 3 year time frame in mind, a great place to go bargain hunting. But if you're expecting outperformance over the next 6 months, it could be a little challenging.
For last 5 years, the India story always has been a vibrant middle class, strong demographics, and reasonable valuations.
Yes.
For next 3 years, what do you think would be the India story?
See, I guess the structural story has not changed, Nikunj. I think, the demographics is a very, very big positive, particularly at a time when, some of our peer group markets are, going downhill on that particular metric. So I think the demographics will remain a very, very strong attraction as far as India is concerned. Liberalization stroke reforms will be a very, very strong theme as we continue to go forward, because I guess increasingly political consensus is building up on a variety of these issues. As far as valuations are concerned, I don't think investors mind paying a premium. You look at it for the last 6-7 years, we've traded on an average at a premium of about anywhere from 20 to 35%. To other emerging markets. So I don't think investors grudges the premium. But for that premium to be justified on a consistent basis, we need to deliver higher growth and we need to deliver higher ROE. And until we did that, I think we were the toast of the within emerging markets. I guess the hiccup that we're facing right now is because on both those fronts there seems to be a speed breaker of sorts. But that said, this is not structural; it's cyclical. And I guess once we get over the hump again, we'll go back to being investor favorites.
But even though we are fixated with the word fiscal deficit, it's interesting that in the last 4 years, India's had a strong fiscal deficit. The gap has been yawning, but the portfolio flows have been strong. So what ultimately do you think a portfolio investor will focus on? A smart fiscal deficit number or high growth?
Well, I guess, it's a combination of both. You can't expect an investor to just focus on one metric and not focus on the other. But from a market's perspective, what gets the markets going is growth. But
which is slowing down.
Which has been slowing down, and which is the reason, which is the reason for our immediate term relative caution. Because let's face it, the government's done an outstanding job on the fiscal deficit front. But as I said, and let's face it also, you need to eventually contain the deficit to get back to higher growth. So, in that sense, the two are linked. You can't de-link them completely. But that said, if you put a gun to my head and ask me to pick one variable, I'd say what the markets want is growth.
So a strong fiscal deficit will keep a rating agency happy, but ultimate portfolio investor wants growth.
He wants growth, yes. Markets are very, very correlated to growth. In fact, we did this exercise, across a variety of macro variables, interest rates, inflation, deficits, growth, etc., and with valuations for the market. And we found that valuations, the strongest correlation for valuations is with growth.
What do you make of the sell-off in the mid-cap space? That space has got decimated.
Well, I guess, there is a combination of fundamental and technical reasons out there. As far as the fundamental reasons are concerned, Nikunj, we must appreciate that mid-caps and small caps tend to be much more sensitive to the growth slowdown that we are facing than the large caps.
Because for them, recovery always comes with a lag.
Yes, recovery comes with a lag. They're more geared operationally and financially. So I think, they're much more vulnerable, which is the reason even the earnings contraction you see in their case is much more substantive than you see in the case of the large caps when the economy slows down. They're very vulnerable. I guess, so that's definitely one part of the reason why, there's been a sell-off there. Secondly, I guess there's also been, a few technical factors that play out there. You have stock pledges. You have, retail investors focused more on some of those names, and when they feel the pain selling out and so on and so forth. So I guess it's a combination of factors.
So have mid-cap stocks fallen in a deep hole, and it will be a while before they will come out of that hole?
I would think so. I mean, the way I'll put it is, you need the large caps to rally on a sustainable basis before risk appetite comes back to the mid caps. It's interesting actually right now if you see the polarization in valuations, or for that matter performance, is very, very substantive across the market. We all like to see the Sensex at 19,000, but that's being held up by a handful of stocks.
Yeah,
I mean, even within
the
Sensex, I mean, you can pick 10, 12 stocks which are really holding the markets up there, whereas the others are already probably at a 16,000 Sensex or a 17,000 Sensex, and the mid caps, as you mentioned, are probably at sub 15,000. But let's face it, risk appetite being what it is, you would need the large caps to rally on a sustainable basis before the mid caps are back in vogue.
Fair point. Before we wrap, construct a model portfolio for us.
Okay, if I were to construct a model portfolio, I think on a sectoral basis, the areas that I would certainly be overweight on are IT services and healthcare. They're both global sectors, and if anything, the global economy is looking better now than it did a few months back. They also have the tailwind of depreciating currency. So these are two areas which I would definitely look at very strongly. I think the government-owned utilities is a space which again looks very, very interesting because these are high-quality companies, defendable franchises in terms of what they do, very good balance sheets, and I guess they would perhaps be at the forefront of trying to revive the investment cycle. And in most of their, in the case of most of these companies, what you find is that earnings growth is very strongly linked to capacity creation. So that space looks very good. The energy space looks good too. I mean, because again, partly for global reasons, but also partially because of local reasons. I think, the government's doing a very good job in terms of, sorting out the energy deficit and the energy subsidies. So that's a reasonably good place to be in. So, yeah, I mean, I would say that, these are 3 or 4 sectors where I would be decisively overweight. I think, these look good to me. Financials, one has to take a balanced view because let's face it, it's 30% of the benchmark index. And so, there's no running away from it in that sense. But I would focus on high quality financials at this point in time because we have multiple headwinds, at least over the next 6 months, slowing growth, perhaps NPL problems coming to the fore, margin compression. So I would focus on the high quality financials, but one has to be represented in that space. Consumption, as I told you, I mean, on the
broadly
margin,
underweight.
Broadly underweight, deteriorating.
Which is FMCG and autos both.
Yeah, I mean, we'd be more underweight the discretionary side and perhaps a little more partial to the staple side, but overall as a category, we'd be underweight. And perhaps likewise for the investment cycle too.
All right. Appreciate your time. We'll leave it there. Thank you for joining us
so
on
much,
this edition of Budget Makers.